Hello, I'm Natalie MacDonald and this is your Week Ahead interview. Earlier today, I spoke to Craig Ebert, Senior Economist at BNZ, to provide us with his views on the economic data releases and market events, which could help shape currency markets for the week commencing Sunday the 9th of September. But before we move on to next week, let's take a look at market response to this week's events. This was the week that ECB President Mario Draghi finally followed through with some of his promises from the previous meeting, announcing that the ECB would be launching a potentially unlimited bond buying programme. This announcement appeared to appease the market somewhat. However, as Craig pointed out, there are still question marks around the US and also signs that things are slowing down markedly in China as well. So let's turn our attention to next week. With a variety of market data, meeting minutes and announcements, Craig's pick of the week as the one to watch was the US Federal Open Market Committee meeting, taking place on Wednesday the 12th and Thursday the 13th of September, and here is why.
It's happening in an environment where the markets are trading as much off sentiment in monetary policy announcements and policy officials and what they say, as well as much as the economic data and reality. So there'll be a lot of focus on that. Of course, it's not just the rate decision itself, which should be fairly straightforward. You can't get much lower than 0 to 0.25%, but the Fed will also be publishing its forecasts, latest quarterly forecast, as well as some thoughts on its cash rate and monetary variables going forward.
Ben Bernanke is expected to speak at the meeting's press conference and, unlike at Jackson Hole, will be able to provide a concrete statement of the Federal Reserve's intended actions. But how solid is the central bank looking at the moment?
There's a reminder that I think the Fed itself is still not entirely convinced of what it should be doing. I think it does seem to be over the line on some more QE, but there are certainly some dissenters on the Federal Reserve as well, so we'll just have to wait and see what they say around all of that.
There are several releases coming out of China on Sunday, including industrial production and retail sales, and Monday sees trade balance import and export data. China's manufacturing PMI dipped to a one-year low of 52 this week, and according to Craig, next week's data will help traders decide just how important this figure is to China's economic sentiment.
I think that the PMI indices have been leading the charge, if you like, in expressing the view that China is slowing down to I think for the most part earlier on people were hoping it was going to be a soft landing because, of course, the Chinese officials are trying to engineer a slowdown. But the question marks now is whether that soft landing is turning to a hard landing.
This data could also prove key to Australia. Events in China have placed some big question marks over the state of the Australian economy, spurred on by disappointing data this week.
It's certainly been borne out by the GDP stats that were released just the other day. Of course, Australia had a very big Q1 GDP number and it slowed down to 0.6 in Q2. Most of the indicators are fairly moderate going into Q3.
On Tuesday, NAB will publish its latest monthly business survey, analysing business confidence and conditions, and are expected to highlight how the mining sector is responding to events in China. Australian consumer confidence is out on Wednesday. And last but by no means least in our pick of next week's movers and shakers is Wednesday's Reserve Bank of New Zealand's rate decision. Craig pinpointed that there will be lots of focus on the quarterly statement from the RBNZ, particularly as it is Alan Bollard's last statement as governor of the central bank before he hands the reins over to Graham Wheeler. So what can we expect here?
We expect it overall to be fairly steady as she goes. It shouldn't provide too much drama. We have very strong expectations the Reserve Bank here will keep its cash rate at 2.5%, where it's been for quite some time now, and also for the bank to publish some forecasts which are reasonable enough. They're not; they still show the economy going in the right direction, and I think it will be associated with a gradual reduction of stimulus OCR-wise further down the track. But there's no immediate expectation the Reserve Bank would have any sort of strong hiking bias.
That's all we've got time for right now. We apologise for any difficulties you may have experienced hearing Craig. We did suffer some technical difficulties, however some great insight from him into possible market movements next week. The Dukascopy TV team will be keeping you updated on all of these events and more. Goodbye for now and have a great weekend.